Inflation premiums. Ever heard of them? They're like the hidden cost that sneaks into your daily life without you even noticing. But what exactly are they? And why should every trader, stockholder, and average person care? Let's break it down. Imagine you're buying a loaf of bread. Now, imagine that loaf costs more tomorrow, next week, and next month. That creeping cost increase? That's where inflation premiums come into play. They're essentially the extra returns that investors demand to compensate for the anticipated rise in prices over time. It's like insurance within trading and investing to protect against the eroding power of money. Now, for stocks, inflation premiums play a bigger role than you might think. They impact the valuation of a company, the expected earnings, and ultimately, your gains. Investors love predictability, and inflation throws a wrench in that predictability. So, they demand higher returns for taking on this inflationary risk. And what about the average person? Well, inflation premiums can affect everything from the interest rates on mortgages to the prices of everyday goods. Stick around, because understanding inflation premiums isn't just for the financially savvy, it's for everyone who cares about maximizing their financial future. When it comes down to how inflation premiums really play out in your everyday expenses, here's what you need to know. It's all about purchasing power. As inflation rises, the real value of every dollar you earn may actually decrease unless wages keep pace. This is where inflation premiums weave into the broader financial landscape, affecting everything from interest rates on loans to bond yields. Take mortgages, for example. When inflation concerns spike, lenders might raise interest rates to cushion themselves against future inflation, which means you might end up paying more over time if you're looking to buy a house. This relationship isn't just a theory, it's a reality that can reshape financial strategies overnight. Switching gears to trading, consider how inflation premiums affect market volatility. Rising inflation can lead to fluctuating stock prices and unpredictable market trends. Traders who understand this relationship can potentially capitalize on short-term market moves. On the flip side, those who ignore inflation premiums might find unexpected risks eating into their portfolios. So, whether you're aiming to better manage your personal finances or enhance your investment strategies, grasping the concept of inflation premiums isn't just useful, it's essential. After all, in the financial world, knowledge is power, and understanding how inflation premiums work could be a critical key to financial resilience and profitability. Let's dive deeper into how inflation premiums influence bond investments, which many consider to be a relatively safe haven in turbulent economic times. When inflation expectations rise, the yield on bonds typically goes up to compensate investors for this increased risk. But here's the catch. As yields rise, bond prices fall. So if you're holding on to existing bonds, your portfolio might take a hit, even as potential returns on new bonds increase. For those trading in stocks, inflation premiums reveal themselves in the behavior of certain sectors more than others. Sectors like utilities and consumer staples might feel the pinch more because they can't always pass on rising costs to consumers. Meanwhile, sectors like technology or healthcare might fare better, depending on how fast they can innovate or demonstrate growth. For investors striving to outmaneuver inflation, examining companies with the ability to maintain or increase pricing power during inflationary periods is crucial. These are typically companies with unique products or dominant market positions. Lastly, for everyday people who may not have vast investments, understanding inflation premiums can guide personal budgeting and saving strategies. It's an incentive to look for savings accounts or investments that at least match inflation rates to preserve the purchasing power of their savings over time. Embracing this knowledge can transform how anyone approaches their financial roadmap, positioning them to weather whatever economic conditions lie ahead. Inflation premiums also have a significant role in shaping central bank policies. Central banks, like the Federal Reserve, are highly sensitive to inflation expectations. When inflation premiums rise, these institutions might respond by adjusting interest rates, aiming to control inflation and stabilize the economy. This means that those inflation whispers you hear about aren't just noise, They can ripple out to spark changes that impact mortgage rates, car loans, and even employment rates. For traders and investors, this connection is critical. It creates both challenges and opportunities. For instance, during periods of expected inflation, you might explore strategies that bet on interest rate hikes or sector rotations, leading to investments in gold or other commodities generally seen as hedges against inflation. Moreover, businesses aren't immune to these movements. Companies might adjust their pricing structures or cost strategies in anticipation of policy changes, affecting everything from supply chain dynamics to wage structures. Understanding these subtleties empowers you to navigate these market fluctuations with more confidence. Whether you're making decisions about your retirement fund or contemplating a major purchase, keeping an eye on inflation premiums allows you to plan proactively rather than reactively, ensuring your financial ecosystem remains resilient and robust against whatever economic tides you face. Now, let's turn our attention to how inflation premiums intersect with global trade and economic growth. When inflation pressures rise in major economies, they can trigger a ripple effect worldwide. You see, countries with high inflation rates may see their currency's purchasing power diminish on the global stage, making imports more expensive and exports potentially more competitive. This shifts the balance of trade and can lead to re-evaluation of international partnerships and trade agreements. Businesses and investors operating in multiple countries need to keep a close watch on these dynamics. An unexpected inflation spike in one country might force a business to rethink supply chain logistics or sourcing strategies. Investors might reconsider the geographic distribution of their portfolios, moving assets to regions with more stable inflationary environments. For consumers, these global inflation premiums can sometimes translate to sudden surges in the price of imported goods, affecting everything from electronics to grocery bills. This understanding doesn't just help global businesses or big investors. It can also inform individual decisions about purchasing goods, traveling, or even career choices. So, whether you're a seasoned investor, a business entrepreneur, or just someone trying to stretch their paycheck further, keeping an eye on both local and global inflation premiums can illuminate the path forward, helping you make smarter, more informed decisions in an ever-evolving economic landscape. As we've unraveled the impact of inflation premiums, the key takeaway is clear. They silently shape every aspect of the financial world, influencing everything from personal savings to global trade. By understanding their role, you gain a powerful lens to view the economy, spotting opportunities and dodging pitfalls. If you're ready to leverage this knowledge, why not start by subscribing to our channel? Join our community where we tackle the complexities of finance, simplifying them to help you make informed decisions. Don't miss out on our future videos designed to empower your financial journey. Keep your portfolio and your peace of mind in good shape by staying tuned. Remember, in finance, knowledge isn't just power, it's profit.